being recorded.
All right, welcome back for video number 2, and this is going to start with a bang because the first thing I want to do is correct something I said at the very end of video number 1. It's something minor, but still. So at the end of video number 1, I waved my hands and I said, you know what, the no hoarding assumption is not a big deal because we're going to be able to meet the production needed to sell at potential anyway before we have any chance to hoard. But of course, that is not quite true, and it's not quite true because for 3 years over here in year number 3, in year number 4, and in year number 5, we are producing below capacity, and down the line, our capacity is insufficient to meet potential sales. So in principle, it is possible that in year 3, 4, or 5, we may want to produce above what is strictly needed to meet potential so that we can hoard inventory in order to sell at a higher level in future years down the road. So of course, here it depends on the time value of money. It also depends on how costly it is to hoard inventories and things of that nature. So we're going to maintain the no hoarding assumption, but it is not impossible here that there may be a way to make even more money by storing inventory early on to the extent that it is possible. But again, we're going to maintain the no hoarding assumption under which the production plan at this point is set. So we know how many units we're going to produce, we know how many units we're going to sell, and we also know how many units we're going to keep in our inventory every year. And with that, the first thing that we can do is compute our operating income. And for that, we need our unit price. And the assumption on the unit price is that initially we're going to sell for $10 each unit. And I should have put an F4 on that. I hope you'll forgive me for not doing that. But how about I put it right here? F4. Boom. And then the unit price is going to grow. It is going to grow every year. So it's going to be times open parenthesis 1 plus the growth rate, which by assumption, if I go back to unit price, this is going to grow by 1%. F4, and we're going to get 1% increase in the unit price all the way to year 10 by assumption. Okay, so that's my unit price. Given my unit price, I can calculate my actual sales, that is to say my sales in dollars, and obviously sales are just going to be my units sold times the unit price, and that is going to be true all the way to year 10. Very good. I have all my sales. Pause this for a minute.
This meeting is being recorded.
Sorry about that. Every time I get an email, my computer wants to pause the recording, which is going to be quite annoying. Hopefully no more emails. Very good. So I have my sales number for my 10 years. So what we have at this point is operating income. What I need next is operating expense. Operating income minus operating expense is going to give me my EBITDA, and then EBIT is simply going to be EBITDA minus depreciation. So let's go and figure our operating expense. As we remember from our assumptions, operating expenses are of two types. First of all, I have a fixed operating cost, and then I have a variable cost per unit, which is going to give me my total variable cost. And this one is no longer per unit. That's my total variable operating cost. Maybe I'll put, for clarity, an operating in here. This is going to be my variable operating cost, and that's going to give me my total operating cost. So total operating cost, obviously when I'm done, is just going to be the sum of variable and fixed, and that is going to enable me to calculate my manufacturing cost per unit produced. And that's how I'm going to figure my operating expenses. I need to calculate how much I have to expend in order to produce each unit. And obviously my manufacturing cost per unit is just going to be the total operating cost. And of course, like a dummy, I put it in the wrong cell. So let me erase this and we'll fix this later. So let's go to our fixed operating cost first. So what is my fixed operating cost? By assumption, in year one, it is $1 million. So this guy here is going to be $1 million, and then that is going to grow every year. So this is going to be $1 million times 1 plus my yearly growth, 4. Very good. And this is going to hold all the way to year 10. My variable cost per unit is, by assumption, $5 in year 1. And this too is going to grow by 2% a year. Here's my 2%. 4. Once again, this is going to be true all the way to year 10. And then finally, the variable operating cost is going to be the variable cost per unit times my unit produced, which is up here. My total operating cost is just going to be the sum of my variable and my fixed. And as I was beginning to say a moment ago, my manufacturing cost per unit product is just going to be the total operating cost divided by my unit produced. Very good. So those last 3 lines, I can just copy them all the way over here for 10 years. And I'm just going to verify that this matches the numbers I have on my notes so that I haven't made a mistake yet. So far, so good. Wonderful. Now that we have our unit cost of production, we have a chance to compute our first main type of operating expense, which is my cost of goods sold. Now notice that here cost of goods sold is not the cost of goods produced in a particular year. It is literally the cost of the goods that I'm going to sell. And under the first in, first out assumption that we're going to maintain in this case, the first thing I'm going to sell every year is whatever inventory I had at the end of the year. These are units that were produced last year. They're going to be the first one to go. So that means that when I figure my total cost in a particular year, I'm just going to start with the cost of my inventory, and then I'm going to look at the remaining units sold, those that I need to produce in that particular year, and that's what I'm going to add to compute my total COGS. So let's go to my notes to see how exactly that is going to work. Let me make this bigger. Very good. So this is section 2 in my notes, the section that's called COGS math. And this equation here is exactly what I just said, that the cost of goods sold by definition is my starting inventory at cost plus the difference between my units sold and my starting inventory. So these are the units that I need to produce this year times the unit cost of production. So in your basic accounting course, you may have learned a different expression, which is my cost of goods sold is my starting inventory at cost plus my unit produced at cost minus my end inventory at cost. And here in this paragraph, what I explain in my notes is that the expression we're going to use, which is the more intuitive expression, is of course, so this is the expression we're going to use. This expression is completely equivalent to the standard accounting expression that you may be more used to. But anyway, what we need to remember is cost of goods sold is starting inventory at cost plus the units that I do need to produce in a particular year times the unit cost cost. And so for that, I need to know what my starting inventory at cost is in a particular year. And so that means that I'm going to have to enter into a different part of the pro forma, which is going to be the investment part of the pro forma. And one of the things in which I'm going to need to invest is my working capital. And my working capital is going to be, first of all, my inventory. I need to finance whatever inventory I need to support my sales. So I'm going to need to produce some liquidity for that. And while we're at it, we might as well add payables. So this is liquidity that I'm going to get from my suppliers. My suppliers are not going to require that I pay them right away, so they're going to extend me a loan. So this is going to be a source of liquidity. But of course, I'm going to have, on the other hand, to extend a loan to my customers, and these are going to be my receivables. So these are the three types of working capital that we're going to have in this particular example. And the inventory that I'm going to write here in this line is going to be the ending inventory. So I'm going to write in every particular year. So for instance, here in year one, I'm going to write the my ending inventory at cost. Okay, so let's go to year one. Year one is quite easy. So we have our ending inventory over here. All I need is my ending inventory at cost. So maybe just to make sure there is no confusion, I'm going to write this as EIC. This is the book value of my inventory, the cost of my inventory, not the number of units in my inventory. And here, what I can do is I can multiply my ending inventory by the unit cost of production. I started with no inventory whatsoever. So whatever ending inventory I have in year one, I had to produce it at this cost. But in addition to this, obviously, under a first in, first out assumption, any inventory with which I finished the year had to be produced during the year, because whatever I finished the last year with, I'm going to sell it first. It's going to be gone. So anything that I have is going to be produced during the year. And what this means is simply that this formula here is going to be good for all of my 10 years. And here I'm taking a peek once again to make sure that I get this right. And so far, so good. All right. Excellent. So now let's measure our cost of goods sold. So what is our cost of goods sold? I'm going to take a peek once again. Starting inventory at cost plus the units that I need to produce times my unit cost. So here I'm just going to write it the long way. This would be 0. Why? Because I started the year without any inventory. Plus, in parentheses, my units sold minus the inventory that I had at the beginning of the year, which is 0. And this is going to be times 7. So my cost of goods sold right here, because everything had to be produced in year one, is simply going to be unit produced times the unit cost of production. And I just put those zeros here for emphasis in the formula to make sure that we're not forgetting about them. It's just that they happen to be 0. Very good. So this is my cost of goods sold. I'm going to once again make sure I got this right, and yes it is. So very good. Now in year two, of course, things become more interesting. What is my cost of goods sold? The first thing I'm going to do is I'm going to sell my inventory, and my inventory here is I computed it at cost. My starting inventory in year two is simply my ending inventory at the end of year one. So this is what I'm going to sell first, and the book value of this is just this number here. And then plus I need to sell this many units minus what I had in inventory at the beginning of the year. It is this number, and this is going to be times my unit cost of production. So again, before I push enter, I just want to go back here for a moment. The expression I just entered is exactly this expression for COGS. Starting inventory at cost plus units sold minus starting inventory times the unit cost. So there we go. This is my cost of goods sold for this year, and now this formula ought to work for all 10 years. Very good. So this COGS, as I said, is our main operating expense, but there is another one which is SG&A. In addition to producing the containers, we're going to need administrative support from headquarters. So there's going to be some overhead. We're going to need some HR support. We're going to need management support and marketing support, presumably, at least. And for this, we have a simple assumption, which is that SG&A is just 2% F4 of sales, which is sales is right here. Very good. So I'm going to copy this across for all 10 years. Very good. So now we have our operating income, we have our operating expenses, and in addition, we already have begun to work on working capital. In particular, we've taken care of inventory. Let us now take care of payables. So what are our payables? We have a simple assumption for that. Our payables are 10% variable cost. So this is going to be 10% F4 times my variable operating cost, which is 2.5 million in year one. What about receivables? Receivables are going to be 10% F4 of sales, and my sales are over here. And we get to copy those two numbers right here, all the way to year 10. Very good. So that means that the total working capital is going to be equal to my inventory plus the liquidity I have to extend to my customer minus the liquidity I receive from my suppliers. And so this is my total working capital in year one. We expand this all the way to year 10. Very good. So this is my total working capital. Now, of course, the investment in working capital is the addition to working capital in a particular year. If I already have that cash around, then I do not need to raise any additional cash. The additional investment in liquidity that I have to make year in and year out is the increase in my working capital. Now, in year zero, of course, I need to, since I start from zero, I need to produce that entire liquidity. So the change is just the entire stock of working capital. But starting in year two, what I'm going to do is I'm going to take the working capital that I need in year two to sustain my operation minus the working capital that I already had invested in year one. And these are going to be my additions to working capital. And we go all the way to year 10. And what you see is something that is very typical in any kind of DCF. During the ramp up period, the quantity of liquidity that you're going to raise is going to be quite large because you start from zero and you have to go to your steady state level of working capital. So you're going to start getting initially high numbers, but in time, as operations stabilize and the quantity of working capital we need becomes more steady, the change in working capital becomes smaller and smaller. And in fact, it would go all the way to zero if there was no inflation. It's because there is inflation in sales, there is inflation in production, we basically grow at a rate which is not zero. And this is why our stock of working capital also has to grow. And so the numbers become very small eventually, but they do not become quite zero as a result of the fact that we keep growing for real and for nominal reasons. All right, so at this point we have our first type of investment. But of course, there are more investments that we need to make. And in particular, we have some physical investment to make in land, in structure, in equipment, in year 0. And we also need to invest in some machines in year 1. The land that we need to invest in is, I guess I should get it from my parameters area. We need $1.2 million in land in year 0. The structure is $4.8 million. And again, we need to separate those simply because they don't depreciate at the same rate. In year 0, I need to buy some machines, namely 1.5 million worth of machine. And in year 1, I need to buy yet more machines for $1 million. Oh, and of course I put this in the wrong place because this is coming in year 1. So this guy should go here. This investment is made in year 1, and then there's no subsequent investment. Good, so having listed all those investments, we can start talking about depreciation. And remember, we want to talk about depreciation because it is a tax deduction, and this is something we're going to have to figure as part of our cash flows. So the structure is going to depreciate. The equipment investment that we make in year 0 is going to depreciate, and the equipment investment that we're going to make in year 1 is going to depreciate as well. Good. So the structure, we make the investment in year 0. Depreciation is going to come starting in year 1, and it's going to be linear. It's just going to be whatever we spent on the structure divided by the useful life, which is 39 years. And we're going to get this every year. Equipment in year 0, likewise, is going to be the size of the investment divided by the useful life of the investment, which is 12 years. And this is going to be linear depreciation. And year 1, because the investment is made in year 1, my year 1 machines are going to start depreciating in year 2. And this, we're going to take $1 million, which is my investment, divided by the useful life of 12 years. And of course, I should have put some F-force on all those things. Let me do it, since it is the proper thing to do. And one more. There we go. Now all those depreciation numbers come all the way to year 10. Of course, I should have put F4 on the first number for this to be right, but I'm just going to recognize the fact that it is constant, and I'm going to copy this all the way to year 10. Okay, very good. So now we have all my depreciation schedule. And with all this, what we can do is compute our EBIT. And what is our EBIT? By definition, EBIT, which we're going to start generating some income from operations in year 1. This is going to be operating income, which here is actual sales minus operating expenses, of which we have 2 types. We have COGS and we have SG&A. So this is EBIT. And then plus depreciation. pardon me, minus depreciation. What am I talking about? This is minus depreciation. So there's going to be three types of depreciation. So I'm just going to sum up my depreciation for my three types of assets that depreciate. And this is going to give me my EBIT. And this is EBIT in year one. And this formula is going to work all the way to year 10. Very good. I have to pay taxes on EBIT. So what are my taxes on EBIT? My taxes on EBIT is just going to be equal to the tax rate. This is my tax rate. Where is my tax rate? And of course, I have not put my tax rates here in my assumption. So we're going to need to do this first. Let me put my tax rates over here. All right, let me find my tax rates in my list of assumptions. So we have three types of tax rates. We have ordinary income tax rate of 35%. That's on EBIT. We have capital gains taxes, ordinary capital gains taxes. That's 15%. And then we have depreciation recapture, which is 25%. So we're going to talk about the fact that in the United States, typically capital gains are taxed in two ways. First, there is the ordinary capital gains tax rate, and then in addition, you get taxed on the depreciation that you've claimed along the way on those assets. So let me turn those into percentages. And while I'm at it, another set of assumptions that I forgot to add, and I'm just going to do it here, is my WACC. So the case says that we're going to finance all those investments with 50% debt, that the required return on debt is 7%. Fraction of equity is everything else, 50%. And the required return on equity is 15%. And this gives me this is going to give me my WACC. Let me first format everything here as a percent. And so let me compute my WACC. My WACC is going to be the fraction of debt in the investment times the required return on debt times 1 minus the ordinary tax rate plus the fraction of equity times the required return on equity. Very good. And let me make my WACC a little bit more precise. And 9.78% is my required rate of return. But anyway, we were on EBIT, and in particular, we want to calculate the taxes on EBIT. And here, it's important to remember that we are computing unlevered free cash flows to the firm. So we are not taking into account the fact that we are going to get a debt deduction in addition to a depreciation deduction, because what we want are unlevered cash flows. And if you are unlevered, then in fact, you're going to owe 35% in this case of your EBIT as taxes. And so this is going to be your tax on EBIT. And there we go.
This meeting is being recorded.
Now at this point, we have everything we need in order to compute unlevered free cash flows to the firm from operations. But what we have yet to figure is our reversion cash flows. The fact that we're going to truncate the analysis after 10 years. In the case, it says literally we're going to sell the property after 10 years. And when we sell the property, it means we're going to be able to sell our building. We're going to be able to sell our machines. We're going to be able to sell our inventory. And we're going to be able to sell our net receivables to the extent that we have any. So let's do the facility for the plant. First, and so let me just write that according to the case, we're going to sell our plant for 6.5 million. That's the assumption that we have here. So now the question is, what are we going to owe in terms of taxes on these 6.5 million transactions? So let me go once again to my notes, and you see that section 3 of my notes is capital gains taxation. So the way to think about this is capital gains is just going to be your net sale price, which here is 6.5 million, minus the book value of the asset. So this is how at least an accountant is going to look at capital gains. And since the IRS uses basic accounting to compute capital gains, this is the expression that matters. But what is book value? So book value is the original basis, namely what you paid for the asset, plus any additional investment that you've made along the way in the asset, minus the depreciation, the accounting depreciation that you've taken. That is book value. So then I can rewrite the expression as two pieces. One, the first piece is NSP minus original basis plus all capex. That's piece number one. And then plus all depreciation. This minus here times a minus there becomes a plus. And it turns out in the United States that typically those two pieces here are taxed at a different rate. This piece number one here, this part of capital gains is taxed at the ordinary capital gains tax, whereas piece number two, all depreciation is taxed at the depreciation recapture tax rate. Okay, so good. So if we go back to our Excel, what we need is original basis plus capex, and then we are going to need all depreciation. And once we know all this, we're going to be able to calculate taxes that we're going to owe at reversion. So taxes at reversion. And finally, we're going to get our net cash from reversion on the facility. Okay, very good. So let's go and calculate our OB plus capex. So original basis is what we paid for the property, which recall was $6 million, F4, and plus any additional capex, say a new roof or anything like that, we would have put on the property, but here there is no such thing. So the original basis is simply $6 million. What about depreciation? So now all depreciation means all the depreciation I've taken on the property since I've owned it. And so I'm going to sum all that depreciation here. And then my capital gains are simply going to be, as it says on my formula over there, net sale prices minus OB plus capex. That piece gets taxed at the ordinary capital gains tax rate of 15% plus all my depreciation times the typically higher depreciation recapture tax rate of 25%. And there we go. This is what I owe in taxes. Since this is what I owe in taxes, my net cash flows, as in the free cash flows to the firm that are available for distribution to debt and equity holder, are simply going to be my net sale price minus what I have to pay the government at the time of sale. Great. So this was the facility. Next, I'm going to sell my machines. And machines are simply going to sell at my book value. So I'm going to have taxes at reversion, which are going to be 0, but we'll just for now leave them, enter them nevertheless. And so this is net cash from reversion for my machines. Okay. So there we go. Let us calculate the book value of my machines. So the book value of my machines is simply what I have paid for them. So what have I paid for my machines? I've paid $1.5 million in year 0 plus a million, I'm sorry, in year 1, and then I'm going to do minus the sum of all depreciation that I have taken on my machine. So I'm going to take absolutely all the depreciation that I have taken. I'm going to sum all of that up, and the net, so what I paid for them minus all the depreciation that I've taken, is my book value. My book value is $500,000. By assumption, we're going to sell the machine at book. Because we are selling it at book, there are no capital gains. That means that my capital gains are 0, and it means that the net cash that I'm going to get from this transaction is just $500,000 minus my taxes, which are 0. So here everything is good for my machines. Next, I'm going to also sell my inventory. If I have some inventory around, obviously the people buying this property are going to value those inventory. They are finished goods that they can sell. And I'm going to be taxed on the difference between what I'm going to sell those inventory for and the book value of those inventory. This is going to be treated as a capital gains by the IRS. Then there's going to be taxes at reversion. And that's going to give me net cash from reversion on my inventory. Excellent. Inventory, by assumption. According to the case, we're going to sell our inventory at market value. So the market value of my inventory is going to be the number of units that I have in my inventory times the unit price at which I get to sell them, which is just 10.94 in year 10. I'm just going to take that inventory and I'm going to put it on the market. Very good. So it's going to sell at market value. But what is the book value of my inventory? The book value of my inventory is the same number of units in my inventory, but at my unit of production. This is how much it costs me to produce them, which is 7.17. And so that number is a lower number than the market value, which means that I'm going to owe some taxes. I'm going to owe taxes on the difference between those two numbers, and the difference between those two numbers is going to be taxed by assumption at the ordinary tax rate of 35%. This is what it says in the case, that those capital gains are treated like regular income when I sell my inventory, and they're taxed at 35%. All right, so now what we need to do is take the net sale price of my inventory and remove what I owe in taxes, and this is going to be my net cash from reversion for inventory, and that only leaves one asset that I'm going to sell, which is my net receivables, otherwise known as receivables minus payables. Those are going to sell at book value as well, so taxes at reversion we know are going to be 0, but we will nevertheless write them just in case we do something different. And this is going to be net cash flow from reversion for my receivables. So I'm going to write net receivables. Okay, very good. So receivables minus payables. By assumption, in the case we're going to sell this at book value. So where are my receivables? They're up here. These are receivables minus my payables. There we go. So I'm going to sell this for this amount. I'm going to owe 0 in taxes, which means that my net cash is going to be what I'm going to sell them for minus my 0 taxes. And everything lines up. Very good. And so now we are done. We're ready to conclude. And how are we going to do this? We're going to compute our incremental unlevered FCFF from operations first and unlevered FCFF from reversion second. And so these are going to be incremental cash flows in the sense that if we invest in this particular plant, these are the net additional cash flows that the corporations is going to generate. So let us calculate unlevered FCFF from operation. So as it says on our cash flow roadmap, this is just going to be EBIT minus taxes. So this is 1 minus tau times EBIT plus my depreciation. So here, because there's going to be quite a bit of depreciation, I'm going to open up a sum and I'm going to take a sum of all the depreciation. And then there's going to be minus my investment. So what types of investments am I making? I'm making an addition to working capital, a big one in year 1. I'm also investing in more machines in year 1. And I guess that is it. There are no other investments. So that should be it. I'm going to push enter. Very good. So those are my unlevered FCFF from operations. This computation is going to be correct all the way until year 10. And what about reversion? So reversion is just going to be the sum that I'm going to get from all my reversions, which was my net receivables, my inventory, my machines, and my facility. Excellent. And then now we have total unlevered FCFF total from purchasing this plant, which is always the sum of what I get from operations and from reversion. And I'm going to copy that all the way down to the end. So these are all my unlevered FCFF. And of course, since I'm doing the total now, I can also figure my initial investment. So I'm going to put it here. So this is going to be minus the, why don't I do minus sum of all my investments in year 0, and they are here. So this is the investment that I need to make. And now I can conclude by calculating my NPV. And my NPV is just going to be equal to the NPV of all the free cash flows I'm going to generate while I operate the plant at what discount rate? WACC 4 of all the cash flows I'm going to get from year 1 to year 10. So this is going to be my NPV. But of course, I also have to figure them or subtract the investment in year 1. And this is going to give me, and this one for whatever reason is not formatted properly. Let me format it as a number with 2 decimals. Very good. And so what do we discover? Having done all those computations, the NPV of the project is very positive at 7 million. And the right conclusion, therefore, to make is if we want to create value for our shareholder, then we should make this investment. According to those calculations, this is a positive NPV investment. And since I've reached my 45 minutes, I'm going to stop right here and we'll continue in video number 3.